Hello, fellow Rebel Capitalists. Hope you are well. So we've got big news today out with consumer confidence. I'm looking at it right on my screen, and unfortunately, it's plummeting. It's kind of that honeymoon phase with Trump seems to be coming to an end. We'll go over that in just a moment. Also, new home prices are starting to fall. I think that's big news with the U.S. economy, especially because our economy is so dependent upon those home prices. And Nvidia, we got to talk about that again. The biggest loss in market cap in stock market history. It's rebounded a little bit today, but yesterday it lost the equivalent of an Exxon. In fact, more. It lost almost the equivalent of a Home Depot and a Toyota in one day. So this just exposes the downside risks in the stock market because it's so concentrated in the Mag 7. We're going to go over that in just a moment. But before we do, let's do a screen share and shoot right over to this recent survey. We got it right here on Bloomberg. And this is from the Conference Board survey. And there's an index they have, and it decreased to 104. Now, the expectations, let's check that out. We'll go over to Market Watch, and we can see it is Tuesday. So consumer confidence numbers right here highlighted. The expectation was 106. We got 104, and that's down from 109. So this 109 represents last month. And that's, yay, Trump won. Oh my gosh, make America great again. The economy is going to boom. All of these tariffs are going to bring these high-paying jobs back to the United States. And because Trump is increasing taxes, that means that we're all going to get rich. Woohoo! And hey, it's the honeymoon phase. I get it. But we can see that now reality is starting to kick in because of the job market, or the lack of the job market. And the Bloomberg article we pulled up goes into that. Now, I saw in the chat, let me actually just write this down, that a lot of people are talking about this huge win for Donald Trump and tariffs. And George, we know that from an economic standpoint, you always talk about how tariffs aren't a good idea, a net negative, and yada, yada, yada. But this is just sour grapes. You're just being too strict of a libertarian. And if you just open your mind and realize that we live in the real world, and therefore sometimes you just got to expand a little bit of government here and there. And proof is Donald Trump just forcing Colombia to bow and kiss the ring with all of his tariffs and sanctions, or at least the threats of the tariffs and sanctions. And he was able to turn Petro, boom, just like that in an hour. So even if he doesn't use these tariffs or sanctions, it proves how good of a negotiating tool they are. All right, we're going to get into that. That's going to be a bonus topic at the end of this video. But getting back to the Conference Board survey on consumer confidence, what's key there, which hopefully you got from what I just said, is not just the fact that it's gone from 109 to 104, but why has it gone down to 104? Why is this, the party over, and now all of a sudden we're in the hangover phase? That's key. So right here we show charts how the consumer confidence has plummeted. In fact, in November it was 112. See, this is when we had the election. And then since, you can see what's happened. We go from 112 to 109 down to 104. So why is this happening? Again, that's key. This is the share of individuals who answered or responded to the survey that say it's getting harder to find a job. Now, we're not at the point where we were, let's just say, going into the election at 18%. But we went down in December to 15, and now we've bounced back up. So a key component of it going from 112 to 109 down to 104 is, again, the job market. And it breaks it down even further when we look at expected incomes. So this is the percentage of respondents that said they expect their incomes to increase. Again, going back to the election, 20%. We fast forward to today, and it's down almost 2 percentage points to 18.3. Now, it still is relatively high for the year, but we have to focus on the trend and which way it's headed. Share saying business conditions are good, and this has just completely dropped off a cliff. Gone from 22 all the way down to 18. So a fall of almost 4%. They say inflation is easing only gradually. And while the labor market looks good on paper, job seekers say it's taking longer and longer to find work, and sentiment has been shaky as consumers assess how Donald Trump's policies will affect the economy. I don't know about that. I don't know if if job seekers or consumers are out there really thinking about, oh my gosh, what are tariffs going to do? The MAGA people think that it's going to make the economy boom. The MAGA people think that this is going to bring all these higher paying jobs back to America. It's somehow not going to lower prices because interest rates are going to come down because Donald Trump is going to force them down immediately. He demands that, as he said, and he's going to bring oil prices down. So although labor costs might go up, everything else is going to go down that goes into these inputs of the stuff we buy. And therefore, on net balance, we're not going to have any inflation. We're just going to have higher paying jobs. As if you can have that without more goods and services being created. But that's the story, right? That's the narrative. And this is, again, the main, that's why I don't think that a large percentage of Americans are sitting there analyzing Donald Trump's policies from a top-down approach, from a 30,000-foot macroeconomic level. I think what they're doing is they're just going out there, and those who are trying to find a job or talking to their relatives or their friends or coworkers, they're seeing or they're hearing, they're experiencing their own life experience is that it's getting harder and harder. And that's what's impacting their mood, or that's what's impacting their view of the unemployment picture or employment picture. Isn't necessarily Trump's policy. It's just what they're seeing boots on the ground. The share of consumers that said jobs are currently plentiful fell to its lowest month since September. Again, it's still pretty high, but we just got to pay attention to the trend. The return of pessimism, this is according to Dana Peterson, chief economist at the Conference Board. The return of pessimism about the future employment prospects seen in December was confirmed in January. I'll be very interested to see what happens in next month's survey. So if we see this continue, it's going to, the more we see this continue, the more you've got to start incorporating this into your analysis of the overall economic conditions. They say buying conditions for big ticket items such as cars, houses, appliances softened. That likely reflects still elevated prices and higher borrowing costs. Yeah, but I think that reflects the job market as well. Inflation expectations over the coming year increased. Other measures of inflation outlook have also picked up recently. Consumers worry about potential tariffs. Maybe. Weaker income prospects likely dampened consumers' vacation plans. I think that has more to do with it than kind of associating tariffs with higher costs. Now let's look at what Zero Hedge has to say. A lot of times Zero Hedge has some really good insights. So I kind of like starting with the mainstream media, and they kind of give you the broad overview and then getting into the nitty gritty here with Zero Hedge. So their title is Conference Board Confidence Continues to Collapse Post-Election. American consumers' confidence fell for the second month in a row. We went over that. They show a chart of exactly what the Bloomberg article was talking about. They say this 4-month low in consumer confidence, despite most other indications of confidence and animal spirits having surged. Yeah. So let's see here. Fartcoin is at 2 billion market cap, but then we have the job market deteriorating. Okay, well, I think one of those is slightly more important than the other. And I think you guys can guess which one I think is more important. So on net balance, I think that's still a bit of a negative. So here is this Dana person that we quoted or we read a quote from earlier. They say consumer confidence has been sideways, has been moving sideways, excuse me, in a relatively stable, narrow range since 2022. January was no exception. Weakened for a second straight month, but still remained in that range, even if it's at the lower part of the range. Okay, so that's what we were talking about before. All 5 components of the index deteriorated. The return of pessimism about the future employment prospects seen in December was confirmed. And here's a chart showing that. They talk about the big ticket items. So here's some positive things that they found in the survey. The consumers' views of their family's current financial situation were more positive, and 6-month expectations for family finances reached a new series high. Yeah, my guess is that's due to the housing market. And look, I have so many friends that literally have Zillow like on speed dial. Not literally. It's like the #1 app on their phone. Like they go to their phones and it's like boom, right there front and center. They've got it like as their homepage, and they sit there and they obsessively put refresh. So in order to get that adrenaline or dopamine rush when they see the price of their house go from, let's just say 515,000 up to 520. In fact, I know people that change the pictures on their, even though it's not for sale, they'll change the pictures on Zillow because they think the algorithm will increase the price of what the house is worth, or what it says it's worth. And therefore that gives them that dopamine rush. So even if they don't do anything to the house, even if the house, they know that it's not worth anymore. Just the fact that they were able to kind of manipulate the algorithm on Zillow to make the price go from 515 up to like 575, they'll do that all day long because it makes them feel better. It makes them feel like they are richer, even though it's not even paper wealth. It's Zillow wealth. So I think that has a lot to do with their financial situation. Because let's face it, unfortunately, we've got an economy that's completely built on asset prices. So who cares what your income is doing? Who cares what the job market is doing? Who cares what the employment picture looks like moving forward? And if you're going to get a raise, or if you do lose your job, it's easy to find another. Who cares about that? Because my home value, according to Zillow, is going up by $50,000 a year. And we know that that's just going to happen indefinitely into the future. I think that's kind of the mindset that leads this survey to come to these types of conclusions. All right, now speaking of home prices, let's go over what's happening to new home prices. And this is really a bizarre juxtaposition because we have overall home prices increasing, but yet new home prices are going down. In fact, going down to the most significant degree that we've seen over the last 3 years. So let's check out this story and see if we can somehow try to connect these dots. So here we are, Market Watch. New home prices dropped to a 3-year low, even as sales improve. So they're selling more houses, but what they're having to do is they're having to discount these houses heavily to sell them, which means margins for these home producers or home builders are decreasing. New home sales ticked up last year, defying higher mortgage rates. But wait, and that's because why? That's because the higher mortgage rates didn't really impact the buyers of these new homes. Because and if you guys haven't heard this, what happens is the sellers, they have to move this inventory. They can't keep it on their balance sheet. So what they'll do is they'll come in and say, oh, well, you want a 3% mortgage? No problem. We'll go ahead and pay any additional interest costs that you have over the span of this loan, taking your effective mortgage rate from 6% down to 3%. And then the home builder just eats the cost. But they say that they still sold the house for list, let's say at $600,000. What they don't tell you is they gave them this credit for $80,000, which brought the real price or selling price down to, low 500s. And therefore, that's why the buyer gravitates over there. They can get a better rate, but this only lasts so long. Right? You can see how this game of musical chairs comes to an end. And that's what happens is the margins shrink to a point where these home builders can't lower those prices or absorb the higher interest rates for the buyer any longer. And then the buyer has to pay the real price. And then you see the amount of homes sold decreasing substantially, along with the profits or the revenues for the home builders. But getting back to the article here, sales of new built homes in the U.S. rose 3.6% in December, marking a positive finish to the year, despite higher interest rates that weighed on builders as well as home buyers. Builders sold more homes in 2024 than they did sold more homes in 2024 than the previous year. Okay. Existing home sales plunged to the lowest level since 1995. So now we're talking about something different. We're talking about new home sales, but now we're talking about existing home sales. So new home sales up, existing home sales down. And this is probably why you see the overall housing market going up, because there was a higher percentage of existing homes sold, right? Even though the amount sold relative to prior years was down. So you have the prices going up for the existing homes to a more significant degree than the prices going down for new homes. So here they go over the new home price fall in 2024. The uptick in sales came as new home prices felt the pressure from high mortgage rates. Unlike resale home prices, which set a new record in 2024, the median price of a new single-family home sold in the U.S. fell to the lowest level in 3 years. That's pretty much down $8,000, but that's in nominal terms. You got to remember, in real terms, obviously it would be down a lot more. So 29% of homes sold by builders in 2024 were priced between $300,000 and $400,000. And here's an interesting chart where they show the prices converging for the median sale price of an existing home compared to a new home. And I think the delta is a result of these new home builders having to sell these homes. They don't have a choice. They've got to turn over that capital. They can't keep these things on their balance sheet. Where the existing homeowner, they're not in that position. Right now, they might have plenty of equity. They got a 30-year fixed rate mortgage that's locked in. They haven't lost their job yet. And they're kicking back and saying, yeah, I'm just going to wait for the market to come to me. I'm going to set a price up here. And if I get the price, great. And if I don't, well, I'm just going to wait it out. Where the home builders don't have that choice. That's why I think if you look at past cycles, usually the home builders, my guess would be, as they fall for, in fact, you can go back here. Yeah, cedar in the cerveza sickness. I'm sorry, that's actually pre-cerveza sickness. That the price of new homes going down, and we see that that led, but just slightly during the GFC. Yeah, it's almost the exact same. And what I'm saying is the exact same is the timing at which new home prices and existing home prices started to fall. little bit different than what we're seeing today. And I want to be very clear. I'm not saying that this means the housing market is going to crash or anything like that. It's just this is stuff we have to pay attention to, right? We can't just bury our head in the sand. The home prices could continue to go up for the next 50 years. Highly unlikely relative to incomes, but hey, anything's possible. But we just have to factor this in and say, okay, what does this mean, if anything? What does the fact that new home prices are at a 3-year low, what does that mean, if anything? Now, one thing I want to point out about this chart is it's not adjusted for inflation. So home prices would still be at an all-time high, but they wouldn't be this high, right? And I think, and also too, this bump and this increase would be a lot lower, and this decrease would be a lot more extreme. They say overall new home construction and sales remains a bright spot in a frozen housing market. This is according to Thomas Ryan, an economist focused on North America and capital economics. Okay, we expect new home sales to continue to grind higher this year, although builders will face growing competition. What that means to me is you'd expect new home prices to continue to decline. But demand from buyers, particularly budget conscious, first time, should stay strong as builders offer incentives to help them afford a home. Yeah, but you see, again, they act, these experts, as though these incentives could just continue on forever. But at some point, you can't continue to sell a loss leader, right? Unless you're making it up on the back end. And these home builders aren't making it up on the back end. So you can't sit there and just lose money on every single widget that you sell and try to somehow make it up on volume. At a certain point, that game of musical chairs comes to an end. Now, will that come to an end this year, 2 years, 3 years? Who knows? I don't know how much margin these home builders have to work with, but my guess is probably not that much. Now let's circle back and look at Nvidia, guys, because this is a story that even if it doesn't create a stock market crash or anything like that, which it probably won't, even if it creates a bear market, just down over the next 6 months, 20, 25%. We forget in the modern age, because we have this recency bias, that 20% down move in the stock market is very common, extremely common, even in the United States. But we've built this economy that's so dependent upon asset prices, it's a much bigger deal now in terms of the overall economy than it was, let's just say, 40 years ago. 40 years ago, we probably wouldn't even have noticed. But let's look at a chart of the S&P 500. Oh, that's crude oil prices. So I'm going to go ahead and leave the log scale in there. I'm going to take out the inflation adjusted. And this goes back, let's keep it a little more modern here. So right at the beginning of the 1980s, we had a decline of more than 20%. Black Monday, that was 87. Of course, we had a decline, I believe, of 20+% in one day. Then we have the recession here, probably looks like close to another 20%er. And even in the dot-com boom, way before it ended, we had a 20% down in the S&P 500, almost a 20% down. Then, of course, dot-com, this huge recession, or this huge balance sheet recession, we go from 1,400 on the S&P down to, call it 820. So that's one hell of a move. You're cutting it in half by, well, you're cutting it by maybe 40%. Everyone knows what happened in the GFC, down 50%. More recently, we know what happened during the cerveza sickness. And even I think that was remember when, I think Jerome Powell, this was back in 2018. Remember they had the market tantrum. I forgot what we were calling it, but I think that was down 20%. And then you have this move right here from 1360. Maybe that wasn't down 20%. But the point is, it's very, very common that what we have seen over the past, let's just say 3 or 4 years, that this is extremely uncommon. And oh, by the way, I think from 2022 to, let's say, the beginning of 2024, yeah, probably not an official bear market. I don't know if we were down 20% during that time. Or actually, right here. I'm sorry. I'm getting the dates wrong. So we top out right around 4,700. And then we bottom out at 35. So call that down 1,200. And we're getting close. We're getting close there. So my point is, even if what's happening with DeepSeek results in this type of move, we need to pay more attention to it today than we did back then, because we have this consolidation where the global balance sheets are highly dependent on U.S. equities. And it's not just U.S. equities, it's the S&P 500. And it's not just the S&P 500, it's the Mag 7. And it's not just the Mag 7, it's Nvidia. Because this is just this, the move in the S&P 500 is just a result, for the most part, of just a few stocks. So if those stocks go down, so goes the S&P, so goes most of the average Joe and Jane's portfolio. So I'm not saying this is a prediction. I'm just saying it's something we have to be cognizant of. And the more you hear about what DeepSeek is doing to the Nvidias of the world, or what the potential is, the more you realize that this could be a complete game changer. Now, over the long run, I think it's going to be very good for the consumer, because the productivity that we'll have with AI is going to come at a much cheaper price, probably free, and it's going to take much less energy and much less resources. This is all very, very good news for the future. But in the short term, this could have a significant impact. And because things are so concentrated in just a couple stocks, that leaves the rest of the market, therefore the economy, susceptible to potential downside risk. Now let's go over the rebound here. So this is good news, at least if you own shares of Nvidia. Up 7% today, but remember it was down 15% or 17% yesterday. So unfortunately, I think the jury's out as far as what this does over the next 2 or 3 weeks. Is this going to be a buying opportunity? Maybe, but maybe not. Because when you look at the trend or the trajectory, or how maybe a better way to say it is, when you look at a chart of how bubbles typically play out, there's always this down phase, and it goes back up, and people think, oh, thank goodness we're going into a new bull market. We just buy the dip, and then they get kicked in the teeth. They get the right hook from Tyson out of nowhere, where the sell-off continues, and then those people capitulate, and that's how you really, really lose money. It's because you keep buying the dip and buying the dip and buying the dip as it goes down further and further and further, so you get to the point where you got to tap out. You got to tap out, and that's when you take the real, real big loss. Again, I'm not saying that's happening. I'm saying it very well could. When you look at a chart, I mean, this is a very classic bubble type looking chart. And it's not that Nvidia isn't the future. The fundamentals are great. It's not the .com because they make so much profit. I get it. But it doesn't mean that the price isn't currently at perfection. And therefore, if we don't have perfection due to DeepSeek, that this continues to trend, not a crash, but a downward trend that definitely impacts the purchasing power of the average American, assuming they've got a portfolio 401k, they're somehow tied to the S&P 500. Now, as we pointed out yesterday, this is affecting a lot of stocks. It's not just Nvidia. I don't know if they list them here, but I wanted to point out the energy stocks. I know Constellation was down 21%. I know this impacted Microsoft. This impacted Palantir, AMD, right off the top of my head. Broadcom, I think, was also down 17%. So this result loss of purchasing power. Hopefully, if you're a shareholder, but maybe it won't. And we have to understand that stock markets don't always go up. I mean, we have that idea as Americans, but if you just go back and look at other stock markets, you can see that isn't always true. As an example, we've got the Nikkei, and we're just now at 39,000, which is basically where we were in 1990. That would not have been a good investment. Let's look at the Shanghai. So Shanghai in 2007 was at 5,900. Today, 3,200. That is, almost 20 years later. So what makes the United States stock market different? Well, the dollar, for one thing, that's for sure. Treasuries, the way the monetary system is. I get it. There's a lot of tailwinds, for sure. But what I'm saying is we have to understand that it is a possibility for the stock market to go down multiple years in a row. And we have to ask ourselves, if that were to happen, and maybe DeepSeek is the catalyst, maybe it's not. But if it were to happen, how does that impact the overall purchasing power? How does that impact the overall economy? And not just the U.S. economy, the global economy, because of how many balance sheets have exposure to not just U.S. equities, not just the S&P 500, but the Mag 7 and the AI, let's say, narrative, or Nvidia. Okay, now let's go over tariffs. We're going to do that bonus topic. I wasn't planning on talking about this, but I know a lot of people are talking about it on Twitter. They're mentioning me, and I saw some people commenting on it. So let's go over that, because we want to look at these tariffs through the lens of reality. We don't want to get tribal. We don't want to get political. We just want to rationally, to the best of our ability, look at these things and look at the costs and the benefits. What people tend to do, and it's not just with tariffs, it's with everything. They take a position based on what team they're on. And then based on that position, they either cherry pick the good stuff, or they just cherry pick the bad stuff and focus on that. That's not the way to allocate resources, scarce resources, with alternative uses. We want to be thinking as much as possible. We don't want to be feeling. And I'm not sitting here saying that tariffs are a net positive. My views are a net negative. But just because you have a different view doesn't mean you're wrong. Maybe you're right and I'm wrong. But my point is, I see very few people actually doing a cost-benefit analysis with any of Trump's policies. And this is what we need to be doing if we are prudent investors. Now, if you want to be tribal, if you want to be political, if basically the Republicans are like your version of the Kansas City Chiefs, and no matter what you do, you're going to be rah, 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 well, then this video probably isn't for you. So my point here is, I think tariffs can be a fantastic negotiating tool, even though I think they're a terrible economic policy for American citizens. But when Trump, let's say, threatens a country like Colombia with tariffs, and Colombia capitulates, we have to understand why they did it, right? Again, this is setting emotion aside, setting Team Red or Team MAGA. We got to set all that stuff aside for a moment, and we have to acknowledge the reality on the ground to determine if that's a big W for tariffs, if that's a big W for Trump's negotiating tactics, or if it even played a role at all. Right? We're just looking at this through the lens of just being rational. Okay. And so many people, I think, see in the mainstream media that the tariffs are why the Colombian president capitulated. Now, let me be clear. The Colombian president is a complete idiot. He's a socialist, but fortunately here in Colombia, they have a decent set of checks and balances. Right? Now, are all politicians criminal to a certain extent? Probably. And this guy is an extreme version of that. But there are laws that he has to abide by. He doesn't have a choice in some matters. Right? So my point here, and let's see if we can pull up an article on this. I'm just going to Google Trump Colombia here. Oh, shoot. It's going to be giving me stuff. Going to be giving me stuff in Spanish. Let's see if I can do English. Here we go. So Colombia yields on U.S. deportation flights to avert trade war. Now, look, what happens is it's written into the Colombian Constitution that you cannot ban a Colombian citizen from entering the country. No matter how much of a crazy socialist you are, no matter how much of a criminal you are, you can't do that. And even if Petro tried to do that, it would be political suicide, because the people that are opposing him in the next election, especially with his approval rating at all-time lows, are going to use that against him, that he violated the Constitution, and along with his approval rating being in the toilet right now, gives him basically a 0% probability that he gets elected. So what I have heard here from local politicians is that regardless of what Trump threatened, Petro would have had to capitulate. So it's not that, Petro said no, and then Trump said, okay, we're going to do these tariffs and sanctions. And then he's like, oh my gosh, okay, yep, then I guess we have to do it. No, what really happens is he said no, and then he gets a call from his advisors and says, look, idiot, you can't do that. You can't do that. And even if you try to do that, it's going to be political suicide. And then he says, okay, we'll go ahead and capitulate. And then Trump at the same time issues this tariff warning, and then the tariffs and the sanctions get the credit for the capitulation. Now, I'm not saying that tariffs aren't a good negotiating tool. They obviously worked really well with Canada. I mean, they got Trudeau out of there in like 2 weeks. But what I'm saying is, in this case, the decision-making process by Petro didn't really have a lot to do with the tariffs. He would have capitulated even if there was no threat whatsoever. So we just got to look at things as they are and not as we wish they were, based on whatever team we're actually cheering for. I think that's the moral of the story here. And I just, from my standpoint, if I was Trump, I would have maybe held off here, because my guess is that he knew Petro would have to capitulate. So why even threaten? I guess you can use that as good PR. But to me, it's like you've got so many bullets in the canister, and why waste a bullet on doing something that doesn't really move the needle too much, right? So that's the point here with Colombia. Let's actually go through this article really quick here to see if it sheds any light on what's happening here. Looming trade war between U.S. and Colombia appears to have been averted. See, and now they're trying to be a little bit more kind to Petro and the Colombian government. You can tell because of the BBC. And I don't know if it was averted after the Colombian government agreed. I'd use the word capitulate and basically just wave the white flag to allow U.S. military flights carrying deported migrants to land in the country. The spat erupted on Sunday when Petro. Yeah, and another thing too that a lot of the local politicians are saying here is they're pissed at Petro because, dude, what are you doing? You know you have to take these people back. You know you have to. So why increase the probability of a tariff or a sanction? That does us no good whatsoever. You're just picking a fight with Trump that is totally unnecessary because it's a fight you can't win. Because even if there wasn't a fight, you would still have to take these people back. Because if you don't, even you want to break the law, it's going to be political suicide. So why even, if it's something you have to do regardless, why even risk sanctions or tariffs, which would likely make the problem even worse? And if you read the like the Colombian news around it, that's what I've read. But even more so, I've got insider information there, and that's kind of the word on the street. Take it for what it's worth. Today's events make clear to the world that America is respected again. No, not really. And again, if these tariffs worked, I would be the first person to say, great job, great negotiating tactic, just like Canada. But I'm not going to say they worked when they didn't work. She added that the tariffs and the sanctions which the Trump administration had threatened to impose on Colombia should not comply. Oh, okay. Would be held in reserve and not signed. Another thing you have to understand when you're thinking about this is if you believe Petro capitulated because of these threats, you also have to believe that he cares about the economy. See, that would be an inaccurate assumption. Because I can assure you, Petro doesn't care about the economy. In fact, he would much prefer the economy to crash. You say, George, why is that? That doesn't make any sense. He wants the economy to crash because then he can blame it on the United States. And this is what would give him a political lifeline. And not only that, if he blames it on the United States, he can blame it on neoliberalism, right? Just like Maduro does, and just like Chavez did before him. And then he can not only get a political win out of it, he sets up the boogeyman as though it's capitalism, free markets, and neoliberalism, which allows him to push his socialist agenda in the next term, assuming that he would get re-election. You see, so from a political standpoint, it would be a huge win for him to have the economy crash because of tariffs and or sanctions. So you see, you've got to realize the perverse incentive here. And that's another reason, along with the insider information that I was getting, and along with the fact that it's just completely illegal based on the Constitution. That's another reason why I think it's pretty obvious that that the threat here didn't really have to do with the decision-making process, because Petro would have loved to have seen the tariffs and the sanctions. That would have been a net benefit to him for sure, because I can promise you he doesn't care about what the local economy crashing would do to the individual citizen. The good news for Colombia is I also heard, in doing some research on this, that the mayor of Medellin is likely going to run for president. This is great news because A, he's good, or pretty good. No politician's great, but he's pretty good, and he's very, very popular in Medellin. So the point there is he's got a very good chance of winning, especially with Petro's approval rating just in the toilet, where it absolutely should be. So we'll have to see how this plays out. And we'll have to see how Trump uses these tariffs in the future. And hopefully, he'll just continue to use these as a negotiating tactic, and he won't actually implement them, or at least not to a significant degree, to where it will negatively, on balance, impact the American society, the average Joe and Jane, especially the poor and the middle class. That's what we always have to factor in. What are the trade-offs here? Because there are no solutions. All right. And on that note, guys, I want to remind you that Thursday, the big birthday virtual conference, we're going to be talking about real estate. We're going to be talking about the Fed. We're going to be talking about macro, the dollar, and we're also going to be talking about commodities with some experts, some good buddies of mine. This is something you're not going to want to miss. Josh, you can go ahead and put up the URL. That's georgegammon.com/birthday. And here are the individuals that we're going to be talking to. This is completely free. This is going to be this Thursday, January 30th, my birthday, 5 p.m. Eastern time. And these gentlemen are going to be going over their predictions for 2025 and their specific niches. So this is something you're not going to want to miss. You can go to georgegammon.com/birthday, sign up. And even if you can't make it live, with that link, you'll be able to see the replay. Guys, as always, make sure that you are standing up for freedom, liberty, free market capitalism. See you on the next video.